财经热点深度解读，大家好，欢迎收看本期的全球财经连线。近期，欧美多国面临能源短缺问题，引发市场高度关注。投资者们担忧，这可能会演变成一场席卷全球的能源危机，让原本就曲折的全球经济复苏之路雪上加霜。与此同时，在通胀压力持续攀升的背景下，全球多个主要央行释放信号，即将开始缩减资产购买规模。超宽松货币时代要结束了吗？第四季度全球经济前景如何？哪些因素对经济复苏构成威胁？作为全球最大经济体，面临多重压力的美国经济，第四季度能否继续强势复苏？现在，我们就来连线标普全球评级首席经济学家 Paul Gruenwald， 一起听听他的观点。Hello, Paul. Glad to see you.
Yeah, first, hello to everyone from New York.
Inflation pressures appear to be peaking in the third quarter, but energy prices are also spiking in some regions. Does this dynamic raise inflation concerns?
First of all, inflation is rising quickly because we have a strong recovery, so that's a good thing. What we're seeing is that in some sectors, the change in demand is running much faster than the change in supply. We saw this in lumber, we saw it in used cars, and now we're seeing it in energy. So you're right, energy prices are rising. The question for us is whether the energy price increases pass through the economy to consumer prices and then to wages. What we're hoping not to see is a wage price spiral, and that will force the central banks to act. So far, we're seeing the initial price pressures lessen as they go to consumers and then wages, but the data are still moving, so we're still monitoring. But so far, it looks relatively narrow, and we're not yet to the point where we have broad-based inflation that would require the major central banks to act.
Why did the spike in energy prices happen?
Again, I think it's really more an imbalance between supply and demand. The global recovery is quite robust. We just increased our global growth forecast, we held it steady at about 5.8%, but we increased our Europe forecast, moderated US, but there's a lot of consumer demand. There's a lot of demand for travel, and the demand for energy has risen quite quickly. On the supply side, we know OPEC is not changing production. We know that the Iran deal is still not happening. There's also some concerns about supply out of non-OPEC countries. So the big jump in demand has not been met by an equally big jump in supply, and that's forcing prices upward for now. So much higher than we originally forecast this year.
Will the supply chain issue continue in the fourth quarter?
Yes, our credit, it depends on the supply chain. Let's take chips, for example, right? The supply chain shortage in chips is something that's impacting automobiles, it's impacting electronics and other sectors, and it is putting a brake on the supply side of the recovery. Our analysts, our experts in those sectors see another 12 months or so before the supply can catch up to the demand. But again, that's a story where we're working from home, so we need more computers. People want to buy another car. Maybe they're living outside of the city rather than in the city. So it's a sign of the strength of the recovery. But just like oil that we just discussed, the supply response in the chip sector has been relatively slow. I wouldn't call it a bottleneck. It's happening that supply is not moving very quickly. We're not losing supply. It's just supply is growing slower than demand. But good for chip makers. Chip makers' revenue and profits are high, but it's delaying the production in some of these key sectors like electronics and automobiles.
Facing the spike in energy prices, will the Fed still begin to taper soon? What's your prediction?
Yeah, well, the Fed has been pretty consistent and pretty cautious about the beginning of tapering. It looks now like tapering will start later this year. The Fed's buying about 120 billion of assets per month, roughly 2/3 treasuries and 1/3 mortgage-backed securities. The plan is to wind down or finish tapering sometime around the middle of next year. So it might be a process of 8 to 12 months, but the current indication is that the economy has enough strength, the labor market has enough strength that the Fed feels comfortable to begin to slow its asset purchases later this year.
How about raising the rates?
That comes later. That doesn't necessarily have to wait until the end of tapering, but the Fed has been pretty clear in its messaging that it wants to stop its asset purchases first, assess what's happening to the market, and then raise rates. Rates are a little bit above zero in the US. They call it the effective lower bound, which is not the same as zero, but we think the Fed's going to move off of the effective lower bound in late 2022, and then 2 more rises in 2023 and 2024 each.
Paul admitted the inflation pressure will last longer. Do you think inflation will become a long-term problem?
No, we don't, for a couple of reasons. First is one I mentioned already, the price impulse. The upstream prices are bigger than the downstream prices, which are bigger than wages. So the impulse seems to be fading as it goes through the system. Inflation's definitely higher and stronger than we thought at the beginning of the year. But again, we don't see this wage price cycle. That would be a worry. And the other thing to note is if you look at the market expectations of inflation, something they call the five-year rate. So they're looking at inflation from 5 to 10 years from now, kind of medium-term concept. The market expectations for US inflation are very well anchored or very close to 2%. So the message there is the market believes that the Fed can do its job. The Fed can deliver average 2% inflation, which is the target. So again, we are seeing much higher inflation than we initially thought in 2021 and probably into early 2022. But the market is confident that the Fed can guide the economy in a way that brings inflation back to the target.
Besides inflation pressures, employment is another goal for the Fed. We saw the latest job report. How do you think about this job report?
Right. Well, one of the big changes in Fed policy over this cycle has been this notion of maximum employment. So that's a new concept. It means, in our view, that the Fed is willing to let the economy run a little bit hot in order to get the unemployment rate down to 3.5% to 4%. You're right, today's job report was weaker than the market expected, but the unemployment rate fell again. It fell from 5.2 to 4.8. So we're getting closer to that rate where the Fed would consider it to be full employment. But what we've seen this cycle and what we see in many cycles is employment tends to lag the recovery a bit. So to give you an example, US GDP is now back to pre-COVID level, to the level of end 2019, but we're still several million jobs short. So we would hope to continue to see strong growth and continued employment gains. The employment numbers today weren't terrible. It was lower than expected, but July and August were both revised up. So remember, this is the first estimate, but the momentum in the labor market seems to be continuing. We still have decent but not great job growth, and the unemployment rate continues to
Mm-hmm. Why is there a huge gap between the real numbers and the expectations?
Well, we can't foresee the future perfectly, so it's always a little bit. And then, the numbers get revised as well. So just to give you a couple of numbers, the jobs number today was 194,000 jobs created in September. But July and August together were revised up by 363,000. So there was a lot of upward revision. So, the Bureau of Labor Statistics that gathers the number takes a partial sample, then they take a bigger sample, and then they finalize the number. It's very difficult to forecast each month exactly, but we and others are looking at the trend. Is the economy improving? Is the labor market improving? Is employment improving across most sectors, which was true today? If you look at the span of private sectors in the U.S., the public sector lost some jobs, but the private sector employment looked pretty broad-based but modest. So we're looking at the trend. The economy is still going to grow by close to 6% this year. Unemployment's falling. Sectors are recovering. So the news is still good. It's a little bit less good than maybe one quarter ago, but we're still in a pretty robust recovery with potentially the highest growth in 30 years in the U.S. this year. So it's not we had one disappointing number today, but we're still on a pretty good path.
Consumption is the backbone of the U.S. economy, but Michigan consumer sentiment remains low in September. How will such a low consumer sentiment affect the growth?
You're right about consumption, right? Consumption is roughly 2/3 of the U.S. economy, much higher than a country like China. China's personal consumption is much lower. So consumer sentiment's very important. It's really depending on two things that are happening. One is the virus and vaccination rates and the extent to which businesses are open. We know that certain sectors like food and beverage, entertainment, travel were very constricted because of COVID. Those are opening up to differing degrees in different parts of the U.S. And I can imagine that the partial resurgence of COVID was, denting or lowering consumer confidence. But again, the broad-based numbers seem to be good. People are spending money again. They are traveling. They are going out to, entertainment. But you're right. In terms of employment and back on the pre-COVID growth path, we're not there yet. There's still some work to be done. But vaccination is the key to this, not just in U.S., but everywhere, right? Now that we have vaccines, if people get vaccinated, then we can open up these sectors and then we can complete the recovery. The recovery has made good progress, but completing the recovery requires widespread vaccination.
Do you think consumption will become stronger in the fourth season since we have a lot of holidays?
Well, yeah, we tend to adjust that. Economists like to seasonally adjust the data. So spending always gets higher toward the end of the year in U.S. holidays, just like it gets higher for Chinese holidays. But we try to adjust every year for the fact that in October and November, before the Christmas holidays or the holiday season in the U.S., we get a lot more spending. Generally, if the economy is doing well and employment is doing well, and there's still a lot of saving in U.S. households from the government measures that has not been spent. So again, we see the economy slowing a bit in the fourth quarter, but the momentum is there in employment. The momentum is there in the economy more generally. So we think we're going to have I'm not in the business of predicting the good holiday season or not, but I think the momentum into the end of the year is still going to be quite good.
What's your outlook for the U.S. economy in the fourth quarter?
Yeah, again, we've got slowing growth momentum. We had 5.7% our latest forecast for the year. That's come down a bit. Earlier in the year, in our previous forecast, we were 6.8. The second quarter was a bit slower than we thought because of Delta. We lowered the forecast, also because of some of the supply chain constraints. So, again, I don't have the exact number for Q4, but the momentum continues to slow. Let's remember the U.S. is a 2% economy, right? So when we get back to the so-called steady state or the equilibrium path for the U.S. economy, the U.S. should be growing by about 2%. So We've got the U.S. going down to about 2 a couple of years out from now. Next year should also be more than potential, but it's not surprising that the U.S. economy is slowing, and many economies right now are growing faster than their potential because they're catching up from the COVID shock. So moderating growth is perfectly consistent with a path where the U.S. goes back to its equilibrium growth rate, which is closer to 2 and not closer to 6.
Some emerging market central banks have raised the rates. Does this mean the era of ultra monetary policy will end?
Yeah, you're right. Several big emerging market central banks have raised rates this year. Brazil, I think, is the highest, 425 basis points. But the Russian central bank has raised rates, also Chile and Mexico, and more recently Colombia. So those countries are seeing the price shocks we discussed earlier, but the pass-through from upstream to downstream inflation in those countries is higher. The central banks have less credibility generally than the Fed and the ECB, so they need to react quicker to inflation shocks. Your question is the right one. It's a big question, right? We went over 10 years from the global financial crisis to now, where inflation was generally too low. Nominal GDP growth was too low. Central banks have rates at the lower bound, and they're doing quantitative easing, and they're having difficulty reaching their inflation target. So our baseline view in S&P is that we're actually hoping for sort of an orderly reflation of the global economy. So if we can get inflation up to the targets and nominal growth a little bit higher, and then higher earnings on the corporate side, higher wages on the worker side, having everything lift up in nominal terms is actually not a bad outcome. That we're forecasting and hoping that that occurs in a way that's largely orderly. We don't want big spikes in inflation and big spikes in rates that tends to destabilize markets. So, but the fact that we're getting a little bit more inflation and then we're moving toward normal policy rates, we would consider that to be a good thing as long as it happens in a broadly orderly way and not a disorderly way.
How long should we take to move into a normal policy?
That's a tough one. So we had the biggest drop on record last year, right? So it started with China, and then it was Europe, and then it was the US. So we had these unprecedented drops in activity, and countries have bounced back, but we're seeing very different outcomes. So China's already recovered its pre-COVID output and is close to its pre-COVID path. As I mentioned, the US has got the level back, but we're not quite on the path yet. Europe is behind that. Some of the emerging markets will never recover. They're going to have permanently lost output because of COVID, but it's clearly too early to say we're in the pre-COVID world. We still have employment gaps, we still have output gaps, and we still have vaccine gaps, right? So I think all of that needs to be normalized before we can say that we're back on some sort of post-COVID, steady state path or equilibrium path for the global economy. That's not a 2021 story. It's not a 2022 story. It's probably the years after that. So it is going to take some time, but it should be faster than the recovery from the global financial crisis, because this one was more of a health crisis. Policymakers essentially turned off part of the economies, the person-to-person sectors, and now we're opening again. So hopefully the recovery will be faster and more complete.
Turkey is an exception. Its central bank lowered the rates a few weeks ago. What happened in Turkey?
You're right that Turkey is moving in a different direction. Most major emerging market economies are raising rates because of high and rising inflation. Turkey's central bank is going in the opposite direction, so that's a little bit unusual. The central bank has a similar objective. They want to make sure inflation is under control and the economy is on a good path. We're watching that economy closely because it is an important emerging market, and it's moving in the other direction. I suspect that if inflation does not get under control, the authorities may have to reverse course. But you're right in pointing it out as an outlier, or a country where we're getting some different policy moves than the peer group. So again, something we'll watch, and they may have to change course, but we'll see how inflation unfolds in Turkey.
If the Fed begin to taper, how will it affect other countries?
Right. Well, we had the taper tantrum back in 2013, and we had the fragile five. Let me see if I remember who those were. It was definitely Brazil, Turkey, Russia, India. I think Indonesia was the fifth one. What happened then is that the Fed started to taper and tighten monetary conditions. That was a bit of a surprise. It looked like rates would be relatively higher and more attractive in the US than emerging markets. So this set off a period of market volatility. The markets had to reprice the path, the assumed path for interest rates and exchange rates. And these countries saw capital outflows that they needed to finance their economy as well as their budget deficits. So it was a turbulent period for some of the major emerging markets. I think the lesson there was that central banks need to be as clear as possible about what's going to start tapering and how long it's going to take. We discussed earlier a lot of messaging coming out of the Fed about the conditions for starting to taper, and some signaling of when that might happen. They're obviously not going to exactly tell the markets or forecast when it starts, but we know there's an inflation objective and an output objective, and the Fed's been signaling that it's going to be later this year. So the idea here is to do it in a way that minimizes the surprises and minimizes the volatility. But you're right, it does have potential spillovers to some of the bigger, more liquid emerging markets. And we'll see what happens this time around, because it looks like we're going to start tapering again in the Fed in a few months.
Some countries' growth seems to be slower, but you still keep the global growth outlook for 2020 unchanged from last update. Why?
Yeah, it was a little bit unusual because we didn't change the global growth rate. We only lowered it a small bit. But we had a lot of variation across countries. So again, the US was lowered by about a full percentage point, but Europe was raised by almost that much. We had strong Q2 in Europe, and because of the progress in vaccination in Europe has been so strong, this grand reopening that we're calling it has been even stronger and more robust than we initially thought. So consumers are spending more money, employment is up, labor market looks pretty good. The savings that were accumulated during the pandemic, because of the pandemic transfers last year, are being spent. So 5% growth in Europe is quite astonishing. So that was a good outcome. And also some of the big emerging markets, Brazil and Russia, were revised up as well. I think one of the lessons from that episode was that countries are learning to live with the virus. So we did a little bit of research that showed for a given level of restrictions on mobility, the impact on consumption is less severe than it was previously. So we had a 2020 outcome where restrictions had a certain drop in consumption relative to the pre-COVID era, but the effect was much smaller this year. So it looks like businesses and households and governments are learning to manage the virus a bit better. That doesn't mean we are out of the woods, but it does mean that the hit to growth from these third and fourth waves of COVID is less than some of the earlier waves.
Mm-hmm. How about China's economy in 2021?
Yeah, China, we nudged the growth forecast down from 8.3 to 8. Again, China was the first major economy to recover from COVID. There's been, good strength in the manufacturing sector. Like other countries, there's still some weakness in the small and medium business sector. Households are not spending as aggressively as they were before. There's some labor migration issues, as you know well, with getting the workers to the jobs in some of the provinces. So it's still a good growth outcome, and China's still driving global growth. I think it's again going to be the biggest contributor to global growth this year. But it's one of the countries where we marked down the growth rate relative to the previous quarter, but it's still very high, and not a huge change, but it is a little bit slower than we had it before.
There's still a large gap in vaccinations between richer and poorer countries. How will this affect global economy?
Yeah, well, that's first of all, we learned that here in the U.S., right? Because we have some states in the U.S. that are highly vaccinated and other states that are not highly vaccinated. The non-vaccinated states got through the first few waves of COVID pretty well, but they got hit hard by the Delta variant. So we have full hospitals, and growth in spending and confidence are slowing. You mentioned the Michigan survey earlier. And you can say the same thing about the global economy. We've got countries that are very highly vaccinated. They tend to be the richer economies, US, Europe, and then some economies in Asia, such as China, have good vaccination rates. But I know we hear this from the health professionals, but I think it's pretty clear, given what we've seen over the last year and a half, that we're not going to be able to exit the COVID era until we get everyone or almost everyone vaccinated. So the next phase of that is clearly going to have to be some of the lower income countries where we see very low vaccination rates. Because if we don't do that, we have a potential for more variants and more waves. I'm not an epidemiologist or an expert on this, but I think we all know enough by now that if we don't have a large pool of vaccinated people, the virus can mutate, and some of these mutations are actually more contagious and more deadly than the previous one. So I think it's in everyone's interest to try to get the vaccination rate up everywhere as quickly as possible.
What risks should we pay attention to in the fourth quarter?
Yeah, there's a couple of risks. I mean, obviously, the virus is the first one. Are we getting people vaccinated? Is the virus under control? Are we able to gradually continue to open up these economies? We do have a lot more debt in the world than we did going into COVID. Even before that, we were worried about debt levels in some countries and some sectors, and now we have even more debt. So that kind of nominal reflation I talked about earlier is important. Can we get earnings and wages and nominal GDP growth up a little bit? That will help to start to pay down some of the debt burdens. And then we've got some big structural shifts post-COVID, right? We have more people working from home. We have people moving to different locations. We have commercial real estate in cities that's less attractive. So we're going to have to find ways to agree on a new composition of growth and living and working arrangements. And I think all of that is still in progress. And then the other risk we talked about earlier was inflation. And I think that's going to be the debate for the next few months or maybe few quarters. Is it temporary, more temporary than we thought, or are we in a new era where we actually have some wage price pressures that we haven't seen in quite some time? My gut tells me that we haven't not broken out of this cycle of structurally low inflation that we saw going into the COVID crisis, but looks like we've got new, a little bit more momentum on inflation, and then some tightness in the low end of the labor market, which is a good thing. But that's going to be the big thing to watch over the next couple of months or a couple of quarters.
All right. Thanks so much, Paul.
Thanks very much. Bye-bye.
See you next time. Bye.
Bye-bye.
目前来看，尽管欧洲和亚洲一些新兴市场国家仍面临疫情的冲击，但是数据显示，这些国家和地区的经济活动一直保持强劲。第四季度，伴随着新冠疫苗接种率的继续提高，全球经济或延续稳定增长的趋势。 以上就是本期全球财经连线的全部内容，感谢收看，我们下期再见。